Okay, welcome, ladies and gentlemen, to another one of our Microcap Fund Manager interviews. And I'm delighted to be welcoming for the first time to our interview series, Steven McCarthy, Portfolio Manager at DMX. We have had representatives from DMX in the past, but we've got the main man gracing us with our presence here this afternoon. Steven, how are you?
Good. Thanks, Mark. And look, we appreciate all the work that you do in the space. So it's good to be here chatting to you.
Stephen, I saw on the newsletters, was it 2 months ago? You guys chalked up the 10-year anniversary of the initial fund. I know you've got two on the go now. But for anybody who hasn't come across you guys in the last decade, maybe just a quick overview of the DMX business and the funds that you run between yourself, Chris, and Michael.
Yeah. So um, at DMX, we've been investing now in microcaps for over 10 years. We manage three funds. It's the DMX Australian Shares Fund and the DMX Capital Partners Fund are very much focused on the micro and nano cap space. Look, we like the very small end of the market, an area we think is inefficiently priced. It's under owned by most retail and institutional investors. It's illiquid, which puts off some investors, but it also means it can't be easily replicated by through ETFs or passive investing. So, look, we believe that micro nano cap space is an area that we can offer a real edge and add real value over time, and I think importantly provide our investors with exposure to portfolios that are genuinely different, under owned companies that have substantial re-rate upside potential from low market caps. And I think it's much easier for a 10 million market cap company to turn into a 100 million market cap company than it is, say, for a billion-dollar market cap company to go to 10 billion. So that's, we like that small end of the market. We like to own companies that are genuinely mispriced, unloved, under-owned, but are actually, still very fundamentally sound, profitable businesses with solid growth potential. We want these small businesses to be able to grow over time into larger businesses and be part of that growth journey. So having that growth outlook and getting comfortable with that growth outlook is important for us. And look, over the last 10 years, we've patiently built a portfolio of positions of those sorts of companies, and we're now substantial shareholders in 10 or 11 small ASX companies that we think the market is ignoring the value and the profit potential. So, look forward to discussing two of these companies that we're substantially have substantial positions in with you today, Mark.
Yeah, thanks, Steve. And just the funds wholesale only or retail and wholesale?
The DMX Australian Shares Fund and the DMX Capital Partners are wholesale only. So
Okay.
we are, yeah.
Just wanted just so people know what the investor base looks like. Yeah, we got two, I think, yeah, vastly contrasting businesses today. The first one we're going to chat about is EDU Holdings, and it's interesting we're doing the interview this week because we might be chatting about it at all if if the EGM had got ahead. I think it was what's today's date? The 25th. I think it was scheduled for Monday originally. But yeah, this business nearly delisted a few weeks ago, but here we are talking about it today. So maybe I think give people a quick overview of what EDU Holdings does, and then maybe just a bit of background on kind of what's kind of happened in the last kind of 6 months, because there's been a lot of moving parts to this business in the last couple of months.
Yeah, no, there's been a bit happening. So, look, it's a stock that we've been in for 7 or 8 years. So we've been through a few ups and downs with it over the years, but it's a higher education provider. So essentially, it's a private university, and there's less than 70 of these types of higher education businesses in Australia. So there's some strong barriers to entry here. The courses that they offer, bachelor's courses, master's courses, required to go through a lengthy and costly accreditation process. And these businesses require substantial back office and student administration infrastructure to support the delivery of these types of courses. So EDU's key business, Ikon, it offers 3 to 4 year bachelor degrees. They charge about $16,000 to $17,000 a year over the term of the course for those for students. And these courses, they're high margin, they're long duration, they're almost contracted type income streams, so provide some really good earnings visibility. And Ikon's key course, the Bachelor of Early Childhood Education, is very popular. It's growing very quickly. Ikon is the largest provider of this early childhood education degree in Australia now. So just that this is the course they developed in 2021, and they've invested in the growth of this course, and as well as other tertiary courses over the years. But the course numbers have been building quickly each year. And last year was a very strong year for enrolment, as EDU was working hard to recruit and enroll students ahead of what was going to be a potential cap on placements for international students that was flagged by the government around this time last year. That cap didn't become policy, luckily for EDU, and so enrolment numbers have continued to grow this calendar year for EDU, and today there's almost 4,000 Ikon or students enrolled in Ikon. They're paying $50,000 for a bachelor's degree. So essentially you have, from this current cohort, $200 million of contracted income, or TCV if you like, which is generating 60% plus gross margin, which will accrue to EDU over the course of the life the students are at undertaking the degree. So we're starting to see the benefit of this strong enrolment from last year and from this year come through in the financials, and the operating leverage is coming through. So earlier in May, EDU released their first quarter numbers. They report on a calendar year basis. So first quarter for 2025, they recorded 5.5 million EBITDA, about 3 million impact, and just in that first quarter alone, exceeded the impact that EDU generated last year, which was about 2.6 million. So reporting some really good numbers, some strong momentum, and we would expect that momentum to continue for the rest of the year. But at the same time that they reported these very strong results, they also advised the market of their intention to delist from the ASX, and they offered a 16.5 buyback for those shareholders who didn't want to continue in an unlisted vehicle. Now, their view for delisting was that they considered that there was that the market wasn't valuing their progress and the work that they had been doing and rewarding that through liquidity or in a share price re-rate. So they were, I guess, frustrated that the market wasn't reacting to a series of good news that the company was putting out, and I think we had formed the view that they would prefer to operate in a unlisted environment because they weren't getting the benefit of being listed, and there was little liquidity, little interest in the stock, and it was costing them money to remain listed. We We were in favour of that. Our preference was for the company to remain listed, and that our view was that liquidity and market interest would come if they continue to generate and these strong results, and the market had some confidence that the company was on a strong growth trajectory. There were other shareholders who also were thinking similar, opposed to the delisting. So the delisting would have required a 75% special resolution, and our view was that, having spoken to other shareholders, the company would struggle to get that, and subsequently the EDU board announced the withdrawal of their proposal. So that meant that, look, the company was going to stay listed, remain listed, and the share price as a result has responded well. And I think this episode has actually probably helped bring some more eyeballs onto the stock, and has highlighted the opportunity to a wider investor base. So that has probably been a positive coming out of this.
Yeah, I think like a bit of boardroom action to attract attention to the stock, and yeah, just for people watching, and before you go and check on the ASX, yeah, I think was it 16 or 16 and a half cents they said the buyback was, and today it's trading around 32. So definitely staying listed seems to have come right. But in terms of the business itself, there's a lot of angst about like international students, and I think they have, while it didn't become policy, I think they definitely have kind of tightened up and made it harder to get visas. In terms of that, long, looking out past this year and next year, because we've had the election now in May, we've had the same government return, so you would think that there will be some form of policy continuation over the next 3 years based on what they've done in the previous 3 years. That forward number in terms of them being able to attract students, are they pivoting a bit to try and get more locals? Because I mean, I'm sure that early childhood development teaching certificate, I mean, with the growth we've seen in that industry over the last 10 or 15 years, I'm sure those are teachers that are in high demand, right across the country.
Yeah, look, I think the key risk here is we don't know what happens to enrollment numbers in 3 to 4 years. So we've got EDU's had a strong intake last year. They've had a strong intake again this year, but certainly as those last year's and this year's intakes graduate in 3 to 4 years' time, then EDU needs to replace those students with new enrollments. And it's important to note that most of EDU's students are international students, but they have been recruited onshore in Australia, so that they already have visas.
Okay.
They're being recruited from perhaps doing other courses or other universities, and the $50,000 degree cost that EDU offers is a substantial discount on what a sandstone university charge. And they also, picking up a childcare education qualification gives them a of getting a job in Australia, relative say compared to a broader business or management degree. So that's certainly there's that pool of about 5 to 600,000 students in Australia that are onshore, that already have visas, and that EDU is looking to recruit from. But there's also a number of other initiatives EDU are working on um, at the moment to really ramp up and front run the, get ahead of that potential drop off of their current intake. And one of those one of the areas is domestic students. So they are launching, or they have launched master's degrees in teaching and counselling, public health, and it's the issue with a private university competing with a public university is that public universities' bachelor degrees are up to 80% funded by the government, whereas with a public university does not receive subsidies funding for a master's degree, so it's a much easier for a private university like EDU's Ikon to compete with a public university at that master's level. So that's certainly an area they're targeting to drive growth in their domestic student base to diversify away from their international base. But they're also targeting, I mentioned how they're currently about 10% or 90% of their international students are recruited from onshore in Australia. They're already in Australia, so there's potential for EDU to build out their offshore agent network and recruitment to target students who aren't in Australia, and they are working on that at the moment. They've got putting resources on the ground in Spain, in Colombia, in India to try and recruit directly from those markets, and they think that in the next 2 or 3 years, up to the number of students being recruited from offshore will rise from 10% to 40% or so. So certainly some scope to expand that market. And then finally, they continue to add new courses, so build out that broadening their course offering. They're working through accreditation for a Bachelor of Community Services course at the moment that helps people looking to get jobs in mental health and counselling, youth support. And they think that degree could be as popular as their early childhood education degree. So, look, lots of levers they have, and to continue to grow. I think the market might be expecting that the enrolment numbers start to fall away in 3 to 4 years, but management certainly aren't planning for that. They're planning for a moderation in the current growth rates, but certainly not a drop in enrolment numbers. So I think that supports that medium term outlook here. The other thing is that over the next couple of years, EDU is going to generate a lot of cash. It could be 10, 12 million of free cash each year the next 3 years. So they're going to have a very healthy balance sheet, and can look at potential inorganic opportunities as well as these organic growth initiatives that they are.
Steve, we are coming up, well, full year for most companies, half year it's gonna be for EDU sometime in August. I'm assuming, Q1 is their biggest quarter of the year in terms of enrollments. It's the start of the, kind of new school year, whether you're at primary, high school or tertiary education. But what are you looking for in the result? Just that they've kind of student numbers are, kind of in line with where they were after Q1. Maybe there's a few dropouts, maybe there's a few enrollments that have come in in different modules or different courses, but that the kind of profitability is kind of maintained. Is that the kind of key headline stuff you're looking for when they do come out now with their half year result in August?
Oh, look, we would expect enrollment numbers to continue to increase from here.
Okay.
Their second trimester for Ikon, they reported very strong growth, and that those students enrolled in that second trimester will just stack on to those enrolled in the first trimester, so you get that stacking benefit over the year, and we would think that the full year result would be ahead of that first quarter run rate.
Okay. Perfect. And we'll
So that impact of in the first quarter of 3 million, that's full tax has been paid there. So we're looking at a full year impact number potentially north of 12 on a market cap of 40 million or so.
okay. I want to move on to our second one, and it's RPM Automotive. Again, a business been around for a couple of years. We've actually had we haven't had EDU present at any of our webinars or conferences, but we have had Clive Finkelstein, who is the CEO founder of RPM Automotive, presented in the past. So people might have seen Clive or be vaguely familiar with the business. But for anybody who hasn't, maybe again a quick overview of what RPM Automotive do.
Yeah, so it's an auto parts distributor, sells wheels, tires, auto accessories to wholesale and retail customers. About 70% of its business is selling tires, but of those tires, about 80% are sold to commercial customers, so trucks, commercial fleets, off-road mining, sort of forklifts. So the exposure to retail to passenger cars is quite small, but it's got a substantial national footprint. 26 locations throughout most of across the east coast of Australia, 11 distribution centres, turning over $120 million of revenue. So it's a reasonably sized business relative to it, given its market cap about 15. But look, we think the core business is okay, and is managed well. But what's really interesting to us is that they've been working the last couple of years, and it's on this, and it's only starting to hit the numbers now, but on a tire recycling opportunity. So there's legislation requiring how tire retailers dispose of used tires, and to ensure that responsible waste management. And RPM have had to historically pay for their end of life tires to be taken away, and that's been a reasonable cost line item for them that they've had to bear. But over the last couple of years, they've been investing in some technology and some equipment to enable old tires shredded and sold to a counterparty, and so that recycling operation is now up and running. They had an investor day in May, formally launching that tire recycling operation, and we're going to see what was historically a cost line item for the company turn into a revenue generating operation, and for which actually RPM starts to make a margin on it. And it's going to be an interesting flip of what was previously a cost line becomes a profit contribution, and we would expect that to be coming to FY26 numbers. If we just look at this year, RPM provided some guidance in May of EBITDA of between 12 and 13 million. We think that converts to around 5, so 6 million impact. So on a market cap here of 15, it's trading at 3 times PE, with the upside to come from next year from this recycling business.
I'm going to play devil's advocate here now, Steve, and on the tire recycling, because we had a tire recycling business listed, N-Tire there up in Brisbane, who went into administration. So it seems like while it's a legislative change, for operators in this business, it seems like a very tough business. And then I saw. Well, I think, was it the start of this year? I mean, it's a rounding error in their business, but car sales getting out of the tire retailing side of the business. So I don't know if that is a positive for RPM in terms of one less competitor, or does it speak to just how competitive like the market that they're operating in, and maybe everybody's not acting rationally and trying to steal share at the expense of margin.
Yeah, look, the beauty here is that RPM have the the used tires that they have to get rid of. So
Mm.
they have the recycling in Campbellfield in Melbourne. There's the premise that half of it's a tire warehouse, half of it's this recycling conveyor belt operation, and the trucks coming from the suburbs of Melbourne full of used tires, and then those used tires get put in the shredder, and then the same trucks go back out with the new tires that from the warehouse. So it's a real the just the reverse logistics here make the economics work really well.
Yeah, I think the entire guys, I think one of the biggest problems they had was with continuous supply. They were a pure recycling business without, I guess, the vertical integration that RPM have. So maybe a slightly different model. Um,
Yeah.
in terms of, they were previously paying somebody else to do it. Is there a possibility of now RPM, being that person, taking tires from some of these other players who, don't want to go and set up their own recycling facility? Is that so not just processing their own end of life product requirements, actually, turning this into a bit more of a broader business where they're doing that on behalf of other retailers, distributors, wholesalers?
Yeah, look, there is, yeah, they have there's the capacity at the moment, they to do that in Melbourne, but over time, RPM would like to introduce that into New South Wales and potentially Queensland, so that to cover that east coast. Um, but yeah, look, the stage one was to get Melbourne up and running and profitable, and that has now been achieved, and so they can look to further expand from here.
Yeah. And yeah, just a reminder for everyone why they picked Melbourne, their Melbourne-based business, just out there on the edge of the Dandenong Ranges. Good, beautiful spot for a site visit. In terms of if we take RPM now again, and you said it's more an FY26 story on the recycling. I'm sure there'll be a small contribution that'll come in this like last month or two now that they've actually got the plant fully commissioned. But what are you looking for, when the result comes out? Is it kind of confirmation that this initial plant is starting to hit its straps and they're kind of confident of the viability and the investment that they've made?
Yeah, look, we'd expect. Well, yeah. So RPM have given guidance in May. I think I think we would hope to see them hit that number. And when we and provide some detail around the contribution from the recycling operation in the last couple of months of this year, and then we can start to roll forward and think about how that looks on an annualized basis going into FY26.
Okay. Right. Steve, two yeah, very interesting stocks for different reasons. I mean, completely opposite ends of the spectrum in terms of industry wise. If anybody wants to find out about DMX, where's the best place to go?
Yeah, look, I'm always keen to talk to potential investors and people interested in the space. My email is Steven with a V dot dmxam.com.au, and also on our website dmxam.com.au is a lot of information, including our monthly letters going back a number of years. Should people want to read about where we've been and what we're doing, and when where we have invested over the years.
Yeah, and I'll just say as well for people, you can sign up to the newsletter and the monthly reports without being an investor. So if you want to kind of track what Stephen and the rest of the team are doing there to get a bit of a feel for the fund and the names in there and you know the strategy, you know, please feel free to sign up and. I know it was a big overhaul of the website, I think maybe back 2 years ago now, so it's very snazzy looking there. If anybody jumps on there, you'll find everything about DMX pretty easily. Stephen, we leave it there. Thank you very much, and hopefully we can catch up maybe the back end of this calendar year after both these companies have reported and we get a bit more of a line of sight on where they're at.
Yeah, that'd be good. Thanks, Mark.
Thanks, Stephen.